9:33 a.m. in London when I'm doing this market update. My name is Alejandro Zambrano, and I'm the Global Chief Market Strategist with ATFX. I have a big team, a few guys in mainland China, a guy in Hong Kong, and as well in Dubai. Myself, I'm based in London and working with guys placed in Europe, but also in Africa. So quite a rather big team providing guys with analysis, and this is our morning update here at the Investing Cube page, but as well on ATFX YouTube channel. So if you have any questions, just pop them in that chat box. If you just want to say good morning as well, or hello, that's always great. Let's begin. We're going to begin with the euro, which is trading slightly lower today. It's down with about 25 pip. But it's not going anywhere fast. In fact, I did some analysis this morning. If we just look at that from that level here, from 23rd of May, when the market started to trade lower like this, to the current price, the market is down with, as you can see here, 548 pip. 548 pip divided over 318 trading days. That is an average decline of 1.73 pip. So less than 2 pip per day. That's what you were made if you would have shorted up here and kept it for more than a year. So there's not a lot of activity going on in this market. If you look at the ATR, the average volatility per week right now, average 14-week volatility is 126 pips. You need to go back into 1985, which is the same year I was born, to find volatility being lower. Actually, yeah, here we go. You see 1985, March 1985. That's how far back you need to go into the market to see volatility at these low levels. So it's very difficult if you're using a breakout strategy. If you're using anything, it's just not going anywhere. Just a lot of just doing nothing. However, don't despair. As you can see here, when volatility was low, eventually it did pick up, right? So when volatility finally starts to pick up, what's interesting here though, you had low volatility, but you still had a bit of a downtrend, right? And I think that downtrend was much deeper than what we're seeing now. But then again, volatility sort of reversed, and the markets finally just started to go upwards like that. And then here as well, like low volatility, actually here, low volatility environment here starts to pick up, and the last sort of episode of low volatility was in the summer of 2014. And if you were around at that time, you might remember that it was here, I think on May 5th. I remember this vividly because the market had a breakout here. So it had a breakout here on May 5th, which proved to be false. Now, that was the beginning of a series of cuts at the ECB, and also the introduction of quantitative easing. So you had a false move. The market had been going upwards for quite some time like that, and then broke to the downside, and then went from 139 all the way down to 104.70. As well, you had other episodes here with high vol. This was on the back of the 2008-2009 recession, and the market turned lower. So, and that's obviously what people are talking about, and that's probably where we could be heading if tariffs continue to be increased, and there's like this economic war between U.S. and China. So don't despair too much. I think things will pick up, but right now, of course, it's just going lower, and my guess is as good as anyone's. So I don't have a strong view. The market trades between 110.28 and 114.10, and that's pretty much the end of it. If you really want to become elaborate, now there's something called the Andrews pitchfork. I never really trust to believe trend lines too much, so as you probably guessed, I never really picked this up. But what the guys do is that they sort of try to find like a midpoint, that's sort of like a trend line that explains price, and then these lines are sort of put from various intervals like that, and then the idea is that you sort of trade this range. It's not exactly like this because there's actually a tool that does it for you, but some people do stuff like this, and from this perspective, yeah, you maybe could have made some money, maybe selling up here, or here, or here, but it's not as easy as it looks like. But you can explore that if you want to. I am not very clear what I like and don't like, and I don't like these markets, so I'm just waiting for either bullish or a bearish breakdown. This is far easier. It's the pound versus the USD, and as you know, the market traded lower on last week. I think it was Friday, and the reason for that is very straightforward. And the UK contracted on a quarterly basis, and it has to do with the fact that just ahead of the initial Brexit date, a lot of these manufacturing firms stockpiled a lot, and now they're not stockpiling. And it's not just that, they're not producing as much as before. There's not a lot of investments in this country because everybody's waiting to see what's going to happen with Brexit. And that's why people are selling the pound, which makes sense. It's both, it's everybody really, not everybody, but as I said before, I know Brexiteers that are shorting this market, and they've been shorting it for quite some time. So, and I think it's fully natural. If you have assets to protect, you would have a position on here. And even if you don't, I mean, I think more, if more people would do that, obviously it will be much lower, of course. But, you know, we'll probably have some inflation on the back of this. And maybe we'll see what happens. The general idea is that when the price of the currency of the country here declines, then buying manufactured products from, say, the UK would be cheaper. As an example, why is the US calling China manipulators, currency manipulators? Well, because China is putting on tariffs on Chinese imports. So if you put a 10% tariff on that, it becomes 10% more expensive to buy, right? This is something that the Americans are paying. And what happens here is that if the currency, though, declines, so suddenly the American dollar is 10% stronger against the Chinese one, then that neutralizes that tariff. You're still going to be paying the tariff, but it doesn't become as expensive as before. And it's the same rationale here. The only issue, though, is that the UK doesn't necessarily have, it's not as export oriented as the Chinese economy is. So the decline in the currency doesn't necessarily translate into, like, it doesn't necessarily offset everything. At the end of the day, though, it's quite straightforward here. The market slid below support. You can see it's rather upbeat, rather bullish. If you would have shorted here, you could have scalped on the bit to the downside. It's now going back up to the highs or to the lows again. I think maybe from the first fib, that's what I would start watching. You just need to understand this is the pound. The pound is sort of famous for being messing with people from a trading perspective. It can sometimes just go all the way up and then it'll just tumble down. But for now, the market is bearish with a 122.11, so there's no real change here to my outlook. I remain bearish. Dollar versus the Japanese yen as well is bearish. My idea last week was to short sell up here. Now, remember, I pushed this up. You know, it would have been better if I would have just kept. I had a view like here, short here for it to go down, which it did. But then I said book profits on that and push this up a bit, because I thought the lift in the stock markets, which did go up higher, would cause dollar yen to trade higher again, but obviously it didn't. It just went down. Going forward now, we can treat the trend as bearish just below. I think it would be enough, like 107.29, and we took out these levels here, but it could easily just sort of go upwards. So it's important for me, I think, at least, to wait for some sort of corrective move, maybe doing something like this. So from the first fib or so, turning bearish, and then target lower levels. I think realistically, the way the world is going, because of all the problems and issues, I think eventually, like, this is quite interesting. Aussie dollar 2016 lows, pound dollar 2016's low, and it seems that everything sort of goes towards those levels. And I think here, realistically, we'll be trading around 100, especially if we have more trade wars, which seems to be likely. Aussie dollar versus the USD. So that's one, actually we're not going to cover that one. Crude oil. So crude oil, West Texas crude oil is just trading sideways. So I've been insisting that we should take it easy until we break either the downside or the upside. I still insist on that. What's quite interesting now is also that we have a triple bottom, 1, 2, 3 lows at the same levels. So as you probably guessed, there's going to be a decent amount of stop loss orders just below this level. So the next time we break it, if we break below that level, I think we can go lower. If you're looking at Brent crude, you know that the outlook there's a bit different. The levels I mentioned to you guys last week remain the same. So we're having potentially that correction to the upside. And then you can then take a decision if that's something you want to trade or not. Now this is gold. Now gold is going slightly lower, which I think is fair. Had a nice little run here. That run was for about, well, look at that, 7.75%. And then fib-wise from the low to the high, we might correct a bit, but I think as long as you're above the August 2nd low, I think the market's going to be bullish. I'm just going to make some adjustments here. I have a suspicion that this is going to be maybe the week where this comes back down again to 1460, and maybe for 1460 I think people are going to be looking to get involved. Look at this, German DAX. So German DAX is trying to stabilize, but it hasn't really managed so good. But we just need to be realistic here. So should we be selling at these levels? Does it make sense to sell here? I personally don't think so, and I suspect that the market can continue to remain bullish as long as you're above 11,558. Might go down, but then potentially upwards. It's not a very good setup, to be honest, guys, but do people really want to sell here? I don't think so. From a risk-reward ratio perspective, if you start to sell here, if you have very high confidence in this one, then yeah, maybe, but you get yourself a 3 times risk-reward ratio. But there's so much support here, so I don't think that would make sense. Might go down, you get a 1-to-1 maybe at best. The reason why I don't trust this too much, because the correction is not strong enough. If you take fib from this move here, yeah, okay, we touched the first fib, but most of the time stock markets tends to correct like 61.8, 80% of the move. The S&P, for example, is a good example of that, where the market from its high to its low corrected slightly beyond the 61.8. Now, if you look at the S&P today, I think from this market here, the market could probably go back down again. Last week I said we can probably go up, and I did an article on this on investingcube.com. I said people probably going to try to book profits and short sell here, targeting the lows. And here, unfortunately, I don't think we should get too excited. I have a suspicion that the market will trade sideways. So I put a line like that, and then a line like that. I suspect that because of the holiday period and everything, maybe we would need to wait until a few more weeks for some sort of breakout. I am guessing that maybe with the ECB rate meeting, you might have some sort of move, a break here as well, maybe depending on what's going to happen with the Fed rate meeting next time around. Like, the Federal Reserve is not as dovish as the market is. If we look right now at the September 18 meeting, there's a 0% chance that the interest rate remains at the current level. So they have to cut with 25 basis points, which is at 53.5% probability, or maybe cut with 50 basis points. But Bullard, as I mentioned before, is one of the most dovish ones. It's not looking for cuts. And, if this doesn't materialize into a cut, if we don't have a cut, it's not so difficult to see the S&P 500 trading back down here again. But for now, at least, the way this looks like, we're gonna trade sideways here as well. But again, don't despair. This is actually good, because when the market narrows down like this, you can eventually, when you have a break to the upside, you'll have a very strong reaction, or when you have a break to the downside, you have a very bearish reaction. Like, this is some sort of triangle right now, right? So, you could potentially have, like, if you have a break, you'll be trading down here again. So So you need to understand that while it might be very short-term boring, you can potentially be very, very good. It's like a pressurized canister, and then just, you know, imagining it exploding or something like that. I'm not sure, but you get the picture, right? Okay, let's see if you have any questions. So any good morning. So I have Marvin, good morning to you, sir. We have Vasilius as well. A little bit more about the DAX, please. And we have Keith, silver looking ready for a breakout. And Goldie says, Keith, I think the upper end in silver is at 1 month candle, which is a big positive. We have Anas Dora saying, hey, Alex, good morning to you. About the DAX then, I mean, the DAX in general, I mean, I personally think it will swing upwards, but it's nothing I would necessarily put my money on. As I explained last week, I traded a bit of the Swiss stock market because the problem here, you see, this one is rather flat. Doesn't have too much momentum. It had some momentum until it took out this level. But like, let me see what's called. This one, I traded this one last week. So you see here you have more of a bullish uptrend, right? Like that. So I bought it here for, well, I bought the first section here. So actually, let me show you what I did. I bought it here, booked half of the position, and then the market slid below, and I put the entry at stop loss at entry, so I got set out at entry more or less. And then I did actually buy here, but I closed it out before the end of the day. And I should not have done that, of course, because the market moved upwards, but it is what it is. Grabbed a little bit of profit here. Because here you have at least that momentum. In the German DAX, you don't have that. You trade below the low, but maybe give it a few more days. The different setups you could employ here. You know, you could maybe buy on a dip, maybe at 11,600, with either stop here, but my personal preference would be a stop here. So that's one option, like that. Something like that. That can give you potentially a good risk reward ratio, but it's a bit difficult though, because the S&P is starting to look to go lower, right? So I think that could be an issue. Gold. So this is silver. So people talked about this maybe bottoming out. People said, okay, this is like a double bottom ish. Well, and then it's like maybe you'll get something like this. Personally, I really struggle to see anything super constructive here. Like, I'm not really sure what we're looking at, if we're looking at anything. But it's definitely bullish in the short term. And if you look at it from a sort of 6-hour chart, you can clearly see how, you know, you had that rally like that. And then support. So if you look to buy here or do anything, this is the low. Like that. Maybe like that. Looking to buy dips here. You could potentially, I think you can even lower this a tiny bit. Maybe to 1609. And then from these levels try to establish. I mean, this is clearly a prior breakout level, so from here. It doesn't mean that it has to go down there. That's just the entry where it's optimal to get involved, I would say. Get a question here from Jamal. How do we know where institutions are buying and selling big orders? How should us retailers place orders in those areas? So, good question. I can tell you like this. So you probably heard it before. They say that the 4-hour chart is the broker chart. Why would it be the broker chart? well, look at it like this. If you look at the big players, like, for example, what's his name now? Stanley Druckenmiller, George Soros, Ray Dalio, there's a few others of these guys. These guys, they're big hedge fund managers. They've been making money for longer than, well, not longer than I've been around in the world, but say 30 years or so. What do they do different to the average retail trader? They hold positions for 6 months, maybe a year. Like, you remember when Facebook declined? When Facebook IPO'd, the share price was here at 44. The market declined with 60%, and then George Soros bought it down here somewhere. And then obviously he kept it. So to begin with, these longer term guys, which are institutions or family offices, these guys, they don't trade very short term. They use, I would argue, at least the daily chart. So, and that's what I use as well, because I'm tired of being stopped out. I was tired of being stopped out, and I was definitely tired of not making money. So I said to myself, I want to put my stop loss at a level. If it breaks, it has to be something serious, and I'm not just gonna be stopped out and then 3 days later the price goes to my advantage. Of course, that still happens. Like, to give you an idea, euro yen, I actually shorted it here. I shorted here on July 23rd, and I was up a bit, and then ECB rate meeting comes and I'm up even more. Now what I did here though is a bit of a different strategy, but I had a very tight stop loss on the other side here, so I actually got stopped out. The market would eventually have reached my take profit level here, right? But the idea is I trade on the daily chart, because the daily chart is what really matters, in sometimes even weekly, but daily is sort of a nice sweet spot. The problem with the weekly is just that when you look at something like a weekly chart, and we'll do like this. So you have a weekly pattern goes like that. And then you're about to break a weekly level. Then what will happen is that on the daily, it will sometimes establish a range, do like that, just around that important level. So then what you can do with the daily, you can try to optimize daily or 4 hour or 6 hour. You can try to optimize this area here to try to trade that. So to keep it very, very simple, as a retail trader, what you could do is you can stop messing around with the shorter term charts. Unless of course you're doing that good. If you're doing that good, you can show that, well, over the last year or so, for most of the months I made profits, and I made money, you know, most of the quarters, look at it like that. I made money trading short term, and it was rather consistent. Then you should just continue to trade short term. But if you are like me, the way I was, and we have 3 months of really good results, and then 6 months of really nothing, giving it all back, and that was the most annoying part. I would be up maybe 30% on the year, and then slowly give it back, and then before the end of the year, I would be down again. Now I don't have that problem. I would have maybe 50% up on my account on very good years, and then I would give back maybe 22% of that, and then but that would be over a long period of time, and then I would have another burst to the upside, and then I would do on average I think about 34% return per year, 34%. So that's what I'm doing now. So that could be the first thing. So online people say you can use the 4 hour as well. The 4 hour apparently is where people put their stops. Now this, I'm not sure if it's correct or not, but I know one guy, he likes to do the opposite. So for example, he never really puts his, I don't understand his system 100%, by the way, but he uses like trend lines and stuff like that to sort of link up lows and stuff like that. So he would do something like this, I would have guessed something like that. So I don't know exactly what he did here, but I think around here he did something similar. So he would say, I don't focus on the big levels, and he would say he wait for a significant move. So when he sees a move like that, a decline, he says, okay, it's bouncing from a trend line, then he would buy. So he wouldn't care about horizontal support and resistance. He would just draw trend lines and then try to buy at these extreme levels, and then he would look for the price to go back. But he's a very clever guy that's been doing this professionally for quite a few years, for his clients and for himself. And he sort of knows, okay, this market is now turning sideways, so he would go against the moves. Like, I remember he actually did sell up here, so he would do stuff like that. But then he would know that in other markets, he would know exactly when not to do that. I think it was wheat. I held a position in wheat, and I think he was buying down here. So when the market was breaking down, I sold, but he told me that he bought. So he bought here, and then he sort of rallied, took it all the way up here or something, and then he said, then it went up, and he shorted up here. But you can see here he got caught out. That's if I remember correctly. So that could be an alternative, because what's interesting many times at these times is that when you start to break these important levels on the daily and so on, you get a lot of volume. So a lot of these guys, they want to get in at good levels. I know, for example, one market maker, so a Brexiteer as well, he sold a ton of a pound up here. Sold a ton of pound up here, this market maker. And then, of course, when the market goes down and his clients want to get involved, he would just, because he sold here. So when people want to buy on the way down, he's just giving them what he already bought. Does it make sense? And what he does, he would just do stuff like this and just focus on these big levels. So to keep it very, very simple, how can you do things differently? Focus on the big levels on the daily charts. Usually those levels are levels that are important. When you see a break to these levels, the trend kickstarts many times, and you don't get stopped out in the short term. It doesn't mean that institutional investors don't trade short term. I know, for example, another company, a friend of mine that I used to work with when I was at FXCM, they're one of the world's biggest market makers in Forex. And it's like a hedge fund, and they just have a bunch of algo guys, a bunch of people just doing coding. And they trade short term as well, intraday. But they're dealing with arbitrage, latency, you know, the price is slow in one place, and then they will try to buy here, sell there, whatnot, to make them back into equilibrium. And it is possible to do very short-term trading. However, the people that do short-term trading successfully, what I have seen, are people that have coded some sort of an algorithm. They've done like an EA, like on the MT4. Because the benefit of a computer is that it will take away that emotional issues that are involved with trading. Because when you're trading short-term, imagine you start out the morning with a loss, and then in the afternoon you have a gain, and then you have another loss, and then you have another loss. You're gonna stop at that fourth trade, after that fourth trade, because humans, they don't like to lose. No one likes to lose, by the way. So that will wear you down mentally. But maybe that fifth or sixth trade that happened just before the close at 9 p.m. or something, those two would have yielded a very nice profit, and you would have come out winning with the same strategy. Now, in algo, you can do that. So the algo, the EA, will trade for you during every days of the day that you want to. And that one doesn't get tired. The only thing you need to do is program it. Now, if it was so easy, why would everyone not do it? Because with an algo, you can only look at so many things. So you will look at maybe the RSI or price action or stuff like that, and you will feed that into the model. And then you need to back test it and make sure that the parameters and everything makes sense. And that, guys, takes a lot of time and a lot of effort. First, you need to learn the program, and then you need to do a ton of back testing. And again, it has limited inputs. Us humans, though, it's easier for us, I think, because we can take in all these inputs. Like, how do you program my view, for example? I mean, you guys come here and you want to know what I think about the markets, right? So I would guess most of you guys would then, you have your own strategy, your own analysis, your own levels, and I guess you would compare that with my levels. And then you're saying, well, I'm not saying you do this, but at least when I speak with people, what they say is that, well, if Alex is bearish and I'm bearish, I trade. If Alex is bullish and I'm bearish, I'm going to think twice about selling. So how do you take that? How do you take this word when I'm speaking to you guys and put that into a model? How can you take a tweet from Donald Trump, just one sentence, and could change everything, right? All of that is something that the human mind can process, but a computer has issues with. So there's both pros and cons with everything. But for us as humans, because we don't like to lose, we don't want to have too much trouble, we don't want to have a stressful life, then I personally think that the bigger picture is easier to navigate than the short term. Okay, I think we're going to wrap things up. Guys, if you like this kind of stuff, like educational stuff, I do host a course with ATFX. So if you open up any account with ATFX, you get access to a course. It's 3 hours and 45 minutes long, where I describe 2 complete trading strategies and explain some of the fundamentals of trading. Not what a pip is, of course, because I assume you know that already, but like how do I define a trend, and I'll show you a ton of examples of that. And if you're interested in that, it's actually for free with any account with ATFX. We also offer coaching, one-to-one coaching. Now that used to be, you remember when I started here at ATFX, working with them a few months ago in February, I said it was 2,000, and we could do special deals. So we had a few of you guys signing up, but now to get the coaching is $5,000 or £5,000 or 5,000 euros. But you can still get that educational course. So if you have any questions, just ping me. I'll send you my email. Actually, I'll send you my WhatsApp, so you can just ping me. And if you have any questions about ATFX, FCA regulated, your money separate from the company money. The money is actually with a big bank here in London. They get scrutinized like everybody else. The company, the people that work in this company, as you know, I used to work for FXCM, used to be the chief market strategist at Amana Capital as well. The guys here used to work for some of the other big brokers, like Apari, eToro, GKFX before joining. So it's a good team we're working with here. The global CEO of ATFX used to be one of the top sales guys at ATFX Hong Kong, and then he worked for ADSS, and I think he worked for a few other firms before setting up ATFX. ATFX by itself in Europe is rather new, but the business outside of Europe is about 10 times bigger than the European business. They're really, really big in China, mainland China, Hong Kong, Southeast Asia, and that part of the world. They also have a nice office in the Middle East doing some good business. And we obviously have this office here in London where we started, or they started literally in October. Okay, guys, if you have any questions, let me know. You have that number there. You can just ping me. Again, free education, free coaching as well if you deposit money. You deposit the money, but that's for you to trade. So there's no fees. So you might say, oh, how does ATFX make money then? Well, the idea is that you learn from ATFX, and then you trade with ATFX. And of course, every time you trade, they make a little bit on that spread. So that's how they operate, and that's how they pay for the courses. So the courses itself is not free. Trust me, they're paying me. But they get their money back when you guys trading, and hopefully you continue to trade with ATFX. Okay, guys, have a great day, and I'll see you guys tomorrow, same time here on investingcube.com and ATFX YouTube channel. Have a great day. Bye-bye.